Hello, ladies and gentlemen. Hi, welcome to the first ever Ask Me Anything for Bitazza Global. My name is Didi, and I'm the Chief Communications Officer. I will be playing the role of a host today in our first ever episode. And before we move on, I'd like to say that actually, over on the other side, Bitazza Thailand, we had been running these Bitazza AMA Ask Me Anything episodes for the past over a year. So today I'm very excited to be leading the first ever Bitazza Global episode with a very special guest, which I will be introducing in a second. So if you are new to the Bitazza channels, Bitazza is actually originated from Thailand under a licensed and regulated environment. And with that, the Bitazza Global and Bitazza Group has plans to also operate and expand to other countries and other continents, also under a compliance environment. And Bitazza also has a utility token called the BTZ, which we will be talking about today, since recently there has been a release of the Whitepaper 2.0, which is an updated version from the original white paper created back in 2018 in order for the Bitazza business in Thailand to acquire the digital asset brokerage license. So with that, let me introduce my guest, the Bitazza Group's chief economist, Thunj Chantramonklasri.
Hello, hi, how are you? Hi, happy to be here. Thanks for having me.
Thank you for being here. I think this type of like non-fast, really casual conversation is very on brand with who Bitazza is, and I think that a lot of people may have been following us, but a lot more people are just getting to know the Bitazza Global platform. And recently, the fiat on ramp feature has been open for many other currencies. So if those of you who had not downloaded the application, look up Bitazza Global in iOS, Android, or Huawei Gallery. So with that, let's go into the content of today, because as we know, any cryptocurrency or even tech company, would be announcing the roadmap and direction and business plans in their white papers. So could you please give an introduction a little bit, and perhaps even about yourself as well?
Sure, thank you. So I actually have a background in, I guess, traditional finance. I studied economics for my undergraduate degree and for my master's at Cambridge in England. And then after that, I did a short stint at a long short equity hedge fund where I was valuing, I guess, equities and just looking at them more from a fundamental approach. And then I moved back to Asia quite a few years ago, where I worked in both corporate finance and also equity research as well. And then towards the end, before I moved out of the, I guess, corporate world to trade for myself, I was also doing financial technology research for one of Thailand's leading banks, K-Bank, Kasikorn Bank, where as well as my normal job doing financial modeling, I also looked into, in a non-technical way, about the applications and just general, even the economics of blockchain technology. And I think that was something I actually petitioned to do, but that's because as well as I think the bread and butter of financial modeling, I've always been quite proficient at. Blockchain was always something that I was personally, intellectually, intuitively drawn to. And I think I was always trying to find a way to work in that. And after I became, I suppose, a self-employed equities trader, and I was doing quite well, I was always trying to look for a scope to find an exciting cryptocurrency blockchain project or company to be a. And I guess amongst the various opportunities that came by, I was fortunate to, I suppose, meet what I think was a very exciting team with a very promising project, where I think all the founders have an extensive track record outside the industry as well. And it really drew me to the project, where I thought I'd be bringing maybe my enthusiasm for blockchain, but also, I suppose, my own expertise that I applied to fields that were proven in fields other than crypto to cryptocurrencies as well. And I think just to add to what you said about how we're trying to do an AMA, I think on the global platform. I think of course everyone knows that this is a tumultuous time for cryptocurrency markets in general, but I think maybe that's all the more reason to have to embrace the spirit of transparency. I think because at the end of the day, if you're transparent and open yourself to scrutiny from the beginning, then I think when the cycles go from boom to bust again, you're not left exposed swimming naked when the tide goes out, so to speak. So that's what today's session. That's what we hope it will be. To I think be a way to communicate transparently what it is we're trying to do, how our platform and our tokens offer something that we think is different, while also drawing on what we think are common sense and even novel approaches that are proven in fields outside crypto as well. Thank you.
It's really interesting because right now, right, a lot of people are kind of having their faith tested during the market conditions, and it's interesting to note that actually Bitazza on the Thailand side was also originated during also a bearish year of 2018. So I think this is a really great opportunity. So I'm agreeing with what you're saying with spending this time to actually declare or discuss openly about the longer plan than what everyone is kind of focused on right now in this moment.
Yeah, no, absolutely. And just, I guess, enough about me, what people tuned in to listen to actually, about the actual second incarnation of the white paper. So I suppose for people who haven't had a chance to look through it, just to break it down, the general structure, I suppose, is that in the beginning, we talk about how, blockchain-enabled solutions could be superior to pre-existing ones, even financial, even digital ones, in terms of offering financial inclusion. And that covers areas of, of course, payment, savings, insurance, and also credit as well. We talk about how, of course, brick and mortar solutions are now, I suppose, being replaced or complemented by, digital ones that might be superior, but blockchain ones could be even higher, offer even greater efficiency or efficacy even. For example, just to in terms of transaction fees, obviously, we know that, transaction fees with, I suppose, with the normal banking system could be considerably higher than just using certain blockchain layer one solutions. But also, I think some of the ones that are less discussed would be, for example, in the field of even savings. Right now, if you look at, I suppose, the Eurozone, the inflation has hit the highest it's ever been for the since the inception of the euro. It's actually 8.6 for June, which is both beating analyst expectations of 8.4 and a considerable acceleration of from 8.1 over May. And immediately inflation is going up. But actually, the ECB and by through the linkage of the euro, the rest of the central banks and the banking system in the eurozone, the interest rates are still quite low. For example, right now, if you look at most of the saving products in Portugal, the highest interest rate you can get for most of the products is actually around 1.2 or less percent per annum. So if you're saving that, well, an interest rate is 8 point something per year. I mean, you're basically just watching your money burn, given everything else. And I think that's that already in itself is a compelling reason to look to, I suppose, crypto and sustainable DeFi models. And I want to say sustainable because it's not just about yield chasing; it's about getting the yield from building new businesses, as we are planning to do. And also, I brought up the example of the euro in Portugal because people say crypto, yeah, maybe you want to use it in Africa, but the currency is not stable. But no, because these types of macroeconomic instability can happen even in an area like the eurozone, which is obviously one of the most developed in the world. So that's the one thing. And of course, how another dimension where I suppose blockchain-enabled solutions could be superior to just normal digital ones is even in the area of credit, for example, because there are pilot projects where you could tokenize within a closed system, so it's not freely traded. The income of farmers in rural communities, for example, and they can borrow against that. There's a project called Grassroot Economics in Kenya that's doing that, and that extends credit to people who otherwise would not be able to borrow just through normal KYC procedures through normal banks, even if you can do the KYC digitally. So I think that's why you have brick and mortar, you have digitally enabled solutions, and you have blockchain enabled solution being yet another level of being efficient and I suppose providing access. So after we discussed that in the beginning of the white paper, we then, of course, we posit the question of, okay, so what's wrong with today's solutions? Because of course, if blockchain solutions are great and they're already being well executed, then there wouldn't be much scope for us to come in and offer something different. But
because essentially everyone has been talking about the impact that cryptocurrency and blockchain technology would have, especially to the audiences and markets, as you had mentioned, and not just emerging markets, but all over the world. So agreeing with you on that, but so please continue with where you would see Bitazza coming in comparison to whether that would be the traditional banking services or financial offerings available in the market, and other blockchain solutions available.
I suppose two problems that we at Bitazza Global have noticed about a lot of the blockchain-enabled solutions is one that of course there's this thing called stable coins, which ironically is not very stable at all generally. In fact, if you I can just tick off some names. Of course, there's Olympus, there's Titan Finance, there's also more recently and very notoriously Terra and UST, the Terra dollar to the Terra USD, and I think these are so they're stable coins that would in some ways are meant to boost the adoption of cryptocurrencies, but most of these stable coins are inherently unstable, and if you actually are unstable, and if you look at the white paper, there's actually an academic paper that we quote that actually shows that for most of them the volatility is actually very high. So there's one problem that we try to address, of course, and the other one is I think something more specific, but specific to our type of platform, which is a brokerage or exchange models, where we feel that there's a limited utility of utility tokens, where if you look at Binance's BNB, you look at crypto.com, CRO, Chronos, the thing is, a lot of these have utilities that are tied to the actual platform, like trading discounts and whatnot. But the further away you move from that into a broader ecosystem, the more limited their utilities are, in that they all offer trading discounts. Some of them offer some of them might offer credit card rebates, but less so now in the case of CRO. But beyond that, there's I guess maybe limited utility in terms of what you can do, and I think that's something we try to embrace, because we think that at the end of the day, we're not just about one platform, we're about building a whole ecosystem, we're about the crypto lifestyle. So our utility token can't be offering utility just for the platform, it has to be for the entire lifestyle as well, and that is something that we can definitely talk about a bit more. So then of course in the next sections of the white paper, we talk about I think maybe some of the unique features that we have, both in terms of our stable coin, the Freedom dollar, and also we talk about BTZ and how our utility token has a unique token economics, which I'm happy to discuss a little bit more if people are interested.
Sure. But let's address the elephant in the room, because we all have witnessed the rise and fall of the Luna and UST tokens, and we are quite aware that this is still very much ongoing, and there are very mixed emotions and views about the matter. So could you please shed some lights on this, and how the BTZ and USD Freedom, as you mentioned, are similar or different from Luna and UST?
Absolutely. And let me broach that by saying we're definitely more different than similar to them. Okay, well, so Bitazza Global, in conjunction with partnership with Freedomverse, are looking at, I suppose, a separately issued tokens that could together maybe work together as a two-token structure. BTZ, the utility token issued by Bitazza Global, and the Freedom Dollar USDF issued by Freedomverse. So about the first part, I suppose USDF is meant to be a stable coin, but the way that is different than most of the stable coins around is we're embracing a philosophy of collateralization evolution. So that's the first major difference. And it's simply what it says on the tin. That as the business evolves and as our ecosystem grows, we're going to evolve the type of collateralization that we use. And the reason for that is, as the study cited in our white paper shows, as a lot of, I think, industry commentators have noted, the most stable coins are fiat collateralized. I mean, that's just a fact right now, and if you look at the ones that are USDC, even USDT, they're the ones that offer much more stability than, well, Terra, for example, UST, but even compared to, I suppose, MakerDAO's US stable coin as well, for example. And yeah, and I think on one hand, using fiat collateralization obviously offers that security. That means it's going to be more stable. But on the other hand, it's capitally inefficient because obviously you can't expand as much, so it's a little bit of a trade-off. And what we plan to do is that we're planning to have USDF, Freedomverse wants USDF to have 3 incarnations. So the first one is that Freedomverse is Freedom Dollar will be completely one-to-one fiat collateralized, which means for every USDF issued, there's going to be $1 of fiat backing. Mm-hmm. And then in the second incarnation, we would move to partial crypto collateralization, which would still be over collateralized. And to explain that a little further, even in the second step, first, we would make sure that our business, our ecosystem has grown enough, that we have the reputational capital and of good management to expand and to swap the collateralization. And when we do, we will still make sure at least 80% of the nominal value of USDF is fiat collateralized. So 80% will still always be backed by fiat, even then. Mm-hmm. And 20% will be crypto collateralized with over collateralization. So for example, we might have $10 million of USDF, and $8 million would be fiat that we have in escrow, and $2 million, will be collateralized by crypto, which could be maybe $4 million worth of Ethereum. So that would be 100% over collateralization of the 20%. And the reason why we're doing that is, of course, one, we want to pivot towards less reliant on just fiat, but also because it is in some ways capitally more efficient, because even though some of the collateral has to be in crypto, which should be over collateralized, at least through DeFi, we could at least get high yield on our collateral than we would if they were all fiat, for example. Mm-hmm. And then in this third step, which I have to stress is something that is in the roadmap, but it's not something that we are just going to go through the motions of and go from 1 to 2 to 3 just like that. We are going to be very careful, make sure that our business and our ecosystem can support it. What we're going to do is do a partial, I suppose, swap stabilization model. I don't want to say just algorithmic stable coin, because for one, it's not algorithmic, because even in the third step, 80% would still be fiat collateralized. So, there's that security. But also the 20% that was crypto collateralized, we might switch it in the third step to being swap stabilized. And by swap stabilization, we mean we would have a mechanism by which people could swap USDF, USDF for BTZ. Yeah, and through that, the swap mechanism should be would how should I put it? It would enable USDF to maintain parity with the dollar, because we would always allow in that step, in theory, for people to swap one USDF with $1 worth of BTZ.
Mm-hmm.
Uh, but I want to stress that, first of all, you know. This is something that we will only proceed towards when we think that our ecosystem is ready, both in the sense of people trusting our general management, but also in terms of there being enough ecosystem revenue to support a genuine fundamental value for BTZ that would help prop up USDF. Now, when I talk about it, I think immediately people watching are like, wait, the swap stabilization thing, I get that you're going to do it in the future, but it sounds a lot like Terra's, Luna and USDT, and we all know how that ended. In fact, it's I think it's important to talk about it, but I think sometimes there are things that there are parts of it that we think was quite novel and quite interesting, and parts of it that we feel were not so well considered. So obviously, what we try to do is move beyond that and come up with a more sustainable solution. And how are we different from UST? Well, very simply, how are we different from Terra USD? Very simply, we're different in four major ways. And the four major ways, the first one is that we would have a partial crypto collateralization. And by that, I mean that we're not going to do completely algorithmic stablecoin model like with Terra USD. What we're actually going to have is we're going to make sure that the amount that is not fiat collateralized never exceeds 20%. And I think that is going to have a big difference, both in terms of economically, but also in terms of people's, people's psychological threshold as well. Because I think for a lot of people, if you tell me, oh, I might lose all my money, even if that hasn't transpired yet, the possibility can be a lot scarier than knowing that at most I might lose 20% of my money. And if I think that would stay in my hand a lot, and I wouldn't panic as much if something like that happened, if there was a little bit of a depegging. Whereas with UST, the Terra USD, there was no bottom threshold, so people freaked out. So I think that's one major difference. A second major difference is that we're going to have collateralization evolution, as I mentioned. So, with the UST, from its inception, it was expecting the market to kind of just have faith that this algorithmic swap stabilization would work. But with us, we're obviously going to do fiat first, and we're going to grow the business, and then we're going to grow the ecosystem, and then we're going to have people trust us. And I think that's a big difference as well, because in a way, UST, its very first challenge came, less than 2 years after inception, so to speak. And I think it hasn't really been proven or tested yet, and that's why I think when things started to go south, they went south very quickly and very south as well. So that's the second difference. The third and fourth differences are a little bit more nuanced, but no less important. So first, of course, we have the fact that we're going to have only partial crypto collateralization or partially swap stabilization. We're going to have collateralization evolution. The third thing is that in that swap mechanism that I mentioned, there's also going to be a delay. And by that, I mean that if you swap your USDF for our BTZ, you don't get BTZ straight away. That BTZ will be locked up. So you get $1 worth of BTZ that you might get in 4 months, for example. And why are we doing that? It's because, essentially we're trying to delay, the maturity of our liability. If you look at it, I think, the thing is, a lot of these problems are not unique to crypto. They have actually been studied extensively in other fields, but maybe people haven't applied the insight. So I actually, studied economics and game theory a fair bit in university, and there's a very famous model of bank runs by Diamond and Dybvig, two very prominent economists, and they point out that one of the major reason why banks have bank runs, where people withdraw so much money, depositors withdraw so much money that the bank can't give back all the money in time, and they go out of business, so to speak. Is that there's a mismatch of the maturities of the bank's assets and liabilities, because the banks, their liabilities are the deposits that people can kind of withdraw whenever, in a way.
Right.
Very simple model. And their assets are long-term investments that they lend out at so that they can get higher interest rate, because that difference, the net interest margin, is how banks make money. With issuing stable coins, you're not trying to be a bank, but there's a little bit of a similarity where obviously even if you have that money, if you have that money as a reserve, but if you don't have 100%, even if you have 80%, if 100% of all your of everyone tries to, I suppose, dump the coins or try to claim the coins, obviously, try to trade it, you don't have the reserve on hand 100%, even when you have 80%. So what do? So in our model, there's a few things. Of course, we cap the part that's not collateralized by fiat at most 20%. We can also pre-negotiate credit lines that we might draw upon, but we probably won't as a contingency. But the last thing that we would do is that we have this delayed swap mechanism where if people want to swap the USDF for BTZ, they can do it, and we will pay them the BTZ $1 worth, but only 4 months from now, for example. So that means that would help, how should I put it? It would help swap out the liability, because instead of USDF that in a way, in some ways you could say is meant to be supported by fiat right now, they would get BTZ in the future. So in a way, we're swapping out short-term liability with longer-term liability. And of course, that mechanism in itself might not be enough if given the pressure, but that's why we have a lot of different mechanisms that together would be, such as the fact that we're 80% fiat collateralized, the fact that we're only going to do this later, the fact that there's a delay in the swap, but also the last and certainly not least difference between us and UST is that by then BTZ, which would help support the value of USDF, in the third incarnation of USDF, would have exogenous revenue supporting its value, and that's what's very important. Let me just pause for a second, but. So this is something I want to stress, because BTZ does not operate a blockchain, as in I think a lot of prominent currencies, whether it's Luna that is essentially what used to pay gas for the Terra blockchain, or even ETH for Ethereum. It's quite common for utility tokens to also function as the I suppose as the gas payment, I suppose as the main currency through which a blockchain, a layer 1 blockchain, actually functions. And BTZ does not have that function. BTZ is actually an ERC20 token, which is currently operating on Ethereum. And I want to point out that this is not I suppose a technical shortcoming, so to speak. It wasn't due to, I suppose, an inability to have that feature, but it's actually by design that we decided not to have that. And I think it's actually important to have that separation in some ways, because it means that the value of the argument supporting the value of BTZ is not contingent upon the price of BTZ. And I know that sounds a bit weird, but okay, let me explain by example. For example, with Luna, one of the arguments propping up the fundamental value of Luna is that if you hold Luna, you get the transaction revenue, a share of it, of the transactions processed by the Terra blockchain. That's fair enough, but as well as the fact that the actual values of the transaction, the process didn't support this. There's also the more fundamental problem is that Terra needs Luna to run, and Terra is a proof of stake blockchain, which means that if nobody stakes Luna, Terra can't process transactions. Now, what happens if in an alternate universe where Luna has not been demolished yet? Suppose it's still doing well. Well, if there's some doubt that the value of Luna is going to stay, and people start selling it, dumping it, and the value of Luna starts dropping. Well, some people might argue, well, you know what? Luna has fundamental value because you're going to be able to get a share of the income from the Terra blockchain. But at the same time, if Luna starts dropping precipitously a lot in value, such that people don't want to hold on to Luna anymore, then that would inhibit the ability of the Terra blockchain to process transactions, because it's a proof of stake blockchain. And therefore, thereby, that would invalidate the argument that Luna would get income from the Terra blockchain, because the Terra blockchain won't be receiving as much income. So in a way, this is the cruel irony of that system, that the point where there's greatest doubt in the value of the utility token powering a blockchain, the point where the price might be dropping the most, and you need the most reassuring support of fundamental value, that's when the actual argument supporting the fundamental value actually disappears, because the blockchain can process transactions as well, maybe. And I think that's why there's a problem. With BTZ, we don't have that, because BTZ, our ecosystem, it processes transaction on a blockchain, a proof of stake blockchain, but it's not one that requires BTZ to run. But BTZ will receive a share of the revenue of our ecosystem, which means that as the ecosystem grows, the revenue that is accorded to the staking pool will go up. And that means that even in the third step, where we're tying USDF a little bit with BTZ, or at any other stage, once the ecosystem grows, suppose people start to have doubt about the value of BTZ and the value falls. Well, our ecosystem can still function, because those two are exogenous. And the support of value of BTZ in terms of the staking income that's going to come, that's still there. So therefore, as people start to have doubt, there's still going to be fundamental support to push up the value. And that's something that is the fourth and probably most important difference between us and UST and Luna, that the support for BTZ's value is exogenous to the value, to the price of BTZ.
So actually, the value of the BTZ token comes then with its utilities, right? So
Yes.
Actually, one of the things that stood out to me in the case study of UST and Luna was that the fact that Luna's value was dependent on the UST token itself. So with BTZ creating its own value through utilities, this is how we would ensure that because there will be all the use cases and real products beyond the platform, right? So in whatever stage, and there's no committed timeline in terms of when we would make the decision, or at which point we would progress into the stage, second, third, and fourth stage. All of this is dependent on the real happenings of all the utilities that the white paper mentions, right?
Correct. With the three stages of the collateralization evolution, it's not something we're gonna just do in a cursory way or go through the motions of. We're focused on expanding, maybe less aggressively in the beginning than some of our competitors, but definitely equally ambitiously and more sustainably.
Interesting. So when we go into the discussion about the utility of the token as well as use cases, the white paper talks a little bit about the product breakdown. Would you care to share on some of the things mentioned?
Yeah. So when as well as the first difference that I mentioned, the second difference of our product is that we're going to have a bigger array of utilities for our utility token, and that amongst other things, as well as trading discounts, we also have a credit card rebates as well, which is something that is done, but maybe not done as extensively, and certainly not with other side benefits as much as we would, and not at the same rate. So Freedomverse is our partner. Freedomverse is launching a lot of products that I suppose enables a crypto centric lifestyle. For example, we have a Freedom card, which is going to be a crypto link Visa card, for example. And we also have Freedom Mall, that's a marketplace where you can pay in crypto. And for all of these, if you have that, that's a bigger ecosystem that eventually there'll be money going to the staking pool for, but also having BTZ and staking certain amounts grants you the, I suppose, different tiers of privileges for the credit card, for example, for the crypto card, which is initially just a Visa crypto debit card. I'm sorry, but and these privileges are not just specific to crypto. I mean, I think you could probably give them more information than me, but it's definitely all the benefits that one would expect from premium cards. For example, we have F&B privileges. We also have, I suppose, concierge services as well. And also, I think for the highest levels of membership, you would also, I suppose, maybe get more face time with some key figures within our company or our network as well, to maybe get more personal insight and really VIP treatment in terms of crypto market colors and stuff like that. Yeah.
Right. So actually, this was summarized in the utility beyond the platform. So whether that would be the Freedom Card, as you mentioned, with rebates of up to 10%, which from my understanding is the highest in comparison to other players in the same industry as us. Secondly, with the recently launched or not even yet to be launched Freedom Mall, which is a e-commerce platform that would be fueled with crypto payment powered by Bitazza. At the same time as well, the Freedom Wallets that allows anyone to essentially create their own super app, and all of these products are fueled by the BTZ token as the real utility. Not to mention just staking BTZ for yield, and so on and so forth, and a more conservative or more a typical use case of using the BTZ to pay instead of fees, and then getting the discount. And as you mentioned, all of this tiered benefits in terms of the holding amount of holding of the BTZ token that allows certain access to different experiences, and even the metaverse office that Bitazza had also recently launched. And how often is it that when you hold certain amount of stocks of a company, and you get to have a direct conversation with the leadership team, and then the community has been something that Bitazza has been driving quite strongly. And even though starting in Thailand, now reaching out to other countries, perhaps in the region of Southeast Asia and other markets that is mentioned inside the white paper itself, which we will get to in a second. But now talking about all of the utilities of a token, another thing that is a topic that a lot of people in the crypto space often talk about, that supposedly impacts or affects the pricing of a token, which would be the burning mechanism. And this is something that it kind of not the newest of ideas. So actually, the white paper 2.0 addresses this a little bit. Should we go into the management? I'm gonna mention putting it in a simple word as like the token supply management. Let's get to that.
Yes. So I think one model that's regulating token supply in the long term that's become very popular is buy back and burn. And for those who are unfamiliar, buy back and burn is simply you issue tokens, and then through some rule or just through discretion, you burn a certain amount of tokens, which is to say you send them off to an inactive wallet, so you can't access them anymore. The logic is very similar, is analogous actually to I suppose stock buybacks, where if you I suppose decrease the amount of shares of ownership or tokens, then theoretically everyone gets a bigger piece of the pie. So we actually wanted to move beyond that, and the reason why is because even in traditional conventional financial markets, you can see that share buybacks, stock buybacks don't always work. And sometimes that's because they sometimes send a signal that the management don't really know what to do with the money. And they're just giving it back. And if that's the case, then obviously, especially in a company that's meant to be in a high growth industry, that could actually negatively affect the perception and the valuation of the shares. And even with the tokens, I think with buybacks that are predetermined, they might boost the token's value a bit, but then after the short run, the token value drops. The reason why was, well, as I mentioned, that's one reason why buyback and burn isn't great. But also another reason why we didn't want to do it, I think it's probably best highlighted by a very interesting paper by Joe Monegro, who is, he's the founding partner of the Placeholder VC, which is active in the space, and also one of the leading crypto thinkers. And he pointed out that with tokens, sometimes utility tokens, you have to think about whether they're capital or whether they're shares. Because to the extent that they're shares, then they give you a participation right in the revenue stream, and of course decreasing it gives everyone a bigger piece of the pie. But also often, especially for up and coming crypto projects, the utility token that you have also represents capital that could be deployed. You can give it to people and let them collaborate or build with you. And if you burn too much of that, even if everyone who is still holding a token gets a bigger piece of the pie, the overall pie might shrink in size because you can't grow the ecosystem. And therefore you have to really think about whether it's always optimal to burn your tokens.
There's like a misconception or assumption, right? That when there's this supply, and then if you get rid of it, then it increases in value, which you're mentioning is not always the case, right? Like that model seems like a little bit simple, right?
Yes, because everyone in theory gets more of what's there. But if you burn all the tokens that you could give to people to build with you, what you get a bigger share of might wind up being a smaller pie. And with us, we're more concerned about building the ecosystem than just making sure everyone gets a big piece straight away. So Joe Monegro suggests doing something he calls buy back and make, where he buys back a bunch of tokens, he gives it to people who you give it to a project that would build with you, for example, in different ways that would grow the ecosystem. And he talks about using a balanced protocol to do this automatically. For us, I think that was an interesting idea. But here at Bitazza Global, I think the emphasis is always to be at the very forefront in a good way, So we thought about how the old model of buy back and burn didn't work so well. Buy back and make was interesting and novel, but we thought about how maybe we could look even beyond that and do something that was both novel, but not just for itself, but because you were offering actually maybe an even better solution, but also something that would, I suppose, draw upon tried and tested conventional wisdom in other areas. Because I think sometimes to do something great, you don't need to reinvent the wheel. You need to simply, transfer knowledge or know-how from an industry where that does work into a new setting where you're simply dealing with the same problems people have already dealt with successfully, but in a different setting. And I think that type of insight is something that was maybe lacking in a lot of the crypto companies' approaches in the beginning, because it's such a new industry. People forgot to look for conventional or unconventional but established wisdoms elsewhere. So for us, so my background, as I told you, is in economics and professionally in finance. I started thinking to myself, and it was a discussion with me and obviously the founders of Bitazza as well, Bitazza Global Management, and we were thinking about what drives a token's value, and I think one thing, a story that I would come back to would be when I was studying in Cambridge. People would talk about John Maynard Keynes, who many says, obviously is one of the most preeminent economists ever. And he likened buying stocks in the stock market as a competition where people were competing in a newspaper, like ran competition, where they're shown a page with 10 pretty girls. And you have to write in which of the faces you think is the prettiest. This is actually a real contest, apparently, that was taking place back then in America. And if you can actually pick the face that everyone on the whole voted as the prettiest, then you stood a chance to win, the money from the prize pool for the week. And then Lord Keynes pointed out that here the difficulty lies in not picking the face you think is prettiest, but you have to pick the face that you think everyone else would find the prettiest. But then, of course, there's an iterative expectation element where you're thinking, but hold on, they're going to pick probably what they think me and everyone else is going to pick, and so on and so on. And the whole point there for me is that in financial markets, oftentimes the price, especially in the short run, is driven more by expectations than anything else. And of course, we want to build the business and build the fundamental value of BTZ, but we also think we want to use a mechanism that help us maybe give some guidance to what kind of expectations people in the market could have. So then we thought about, okay, so these are the elements. We want to use the tokens productively, like capital, not just shares. We want to manage people's expectations to help lift up the value of the coins. And we also want to grow the ecosystem so that, as our token is deployed as capital to build the ecosystem, the fundamental value accorded to the BTZ holder is also going to improve. So we thought about all these three elements, and the model that we came up with, which we believe is actually quite novel, in that I don't believe it's actually been done before, is called buyback, or rather, to be more accurate, redistribute and signal. So there are two components: redistribution of tokens, and the second one is to use a redistribution to send signals in the market.
Interesting. So I think for the audience that's watching us, let's go dig a little bit deeper into what you mean by signaling. And if it all concerns the community and token holders, I think this is quite an interesting idea.
No, absolutely. So in the first part, what we're going to do is, as BTZ becomes more widely traded, as the ecosystem grows, there'll be channels through which we will, retrieve BTZ. Sometimes we might use a portion of the ecosystem revenue to buy back some BTZ from the open market if we think it's severely underpriced, but also because through Freedomverse, which is our partner, for example, the Freedom Mall programs, a lot of the other programs, they will require payment in BTZ. So we'll be getting BTZ through that channel as well. So whether it's buyback or just us getting it, the main thing is that we will redistribute these BTZ. We won't burn them so that we can still use them, but we're going to redistribute them. And the way we're going to redistribute them is similar to buyback and make. We're going to give it to people that we think can create the greatest value for the ecosystem, the people who deserve it the most, the ones who believe in us the most. But the signal element in redistribute and signal comes in, because our redistribution process will be in a way where we hope and we envision would create strong signals in the market as well, that there are people who believe in our token, and therefore, given everything else, everyone else can also have faith in the short and medium term value of the token as well. The way that we do that, I suppose that there are two main channels. One, with some of the BTs that we get, when we redistribute them to our Freedom Mall partners, for example, or even, general layered, general partners who might build on our ecosystem, we would probably have the management and the committee together. What we will do is that we have the management committee use their discretion and also look at, the performance of different partners, and then we'll see which ones historically and also in terms of the plans going forward look to be contributing the most to our ecosystem. Like, for example, with Freedom Mall, we might think this retailer is really listing a lot of products that people really want to buy. They're selling a lot, a lot of transactions happening because of their product. So this is something that would benefit both them if they get to keep using our platform, but also our users would benefit because they'll get more access or continued access from a retailer or vendor that sells a product that they really like. In that case, we would sell off we would sell off the BTZ that we're going to redistribute to the vendor, because the vendors have to pay us in BTZ to actually continue using the platform. But we would sell at a price to what they can buy it at the market from. So in a way, that way there's an incentive, I suppose, for the retailers who believe the most, who most believe in our platform, who believe in our platform the most strongly, to buy it. On one hand, if you don't believe in Freedom Mall, if you don't believe in the Bitazza ecosystem, there's really no point in I suppose buying these tokens, because you would be bad through a smart contract, through them being locked up, from selling them in the market. They can't buy it and dump it on the open market for profit. They have to buy it, lock it up, so they can keep being our partner in Freedom Mall, in the Bitazza ecosystem. You would not do that unless you believe that the ecosystem, that Freedom Mall, everything else would keep growing. So in a way, we're rewarding our most productive partners, but also by them doing that, they'll be sending a signal that they and other people who buy these discounted BTZ to keep staking them and keep working with us, they believe in our ecosystem. And that's a signaling mechanism as well. On the other side, which is a little bit more complicated, I suppose, is that we would also run an auction for BTZ that we're going to redistribute. The auction is not one where people actually have to pay us anything. They're just offering to stake the BTZ they already have. But of course, I suppose instead of offering to pay high amounts, here you offer the stake ever higher amounts. And the more you offer the stake, the higher your bid. And we would, pre-specify how long you have to stake your tokens for.
Which shows like commitment and I guess trust in the ecosystem, right? So actually, this is giving me a lot of resemblances of governance. When DeFi was first introduced as an idea, more than a year ago, a lot of the projects were talking about, if you hold this token apart from getting such and such, you also get to decide the direction of the ecosystem. So this sounds a lot like that.
Yes, one of the utility of BTZ is that eventually it wouldn't be a complete full-fledged DAO, because I think at the end of the day we want to have best practice business. We want to uphold, I suppose, a lot of business best practices and all that. And I think obviously some guidance is still necessary, but we would have elements of the direction of how I think our ecosystem grows that you could vote in with BTZ. So now that you mention it, yes, BTZ will eventually have voting privileges as well as soon as we launch, I suppose. Not a full-fledged DAO, but something resembling that. Definitely democratize. When we're going to democratize, the part of the governance of the ecosystem. But just to get back real quick to what I was saying, the way that we're going to auction the BTZ, there's a section in the white paper that you can get into if you're interested. But just to simplify it, essentially, we're not just going to auction it normally. We're going to use this thing called the candle auction that Polkadot also uses as well for auctioning off their parachains. And to summarize, essentially, we studied extensively different types of auction: British auction, where the price goes up; Dutch auction, where the price goes down; candle auction, where the ending of the auction is randomized. And here we would do it with a blockchain-enabled system. So it's actually not just a person pressing a button. It's something that you can verify is random. And candle auctions will be probably the most optimal solution that you can have for something like this. So just, I suppose, in a nutshell, the auction for BTZ to the general holders and just market participants at large, which is the other way we're going to redistribute the BTZ. That's something that we will use a blockchain-enabled candle auction for, because that's proven to be very efficient.
So essentially, a lot of the direction involves all of the stakeholders involved in the ecosystem, right? So not just the traders and not just the partners, not just the merchants that are essentially using one of the Freedom products, but this involves essentially everybody. This sounds also, because we talk about this a little bit in the white paper, that Bitazza could be going towards the direction of becoming a DAO.
Yes, I touched upon that just now. I was saying that we wouldn't become a full-fledged DAO, and that's because at the end of the day, the benefits to what greater participation, of course, there's everyone gets to feel like they're a stakeholder, and you can get new perspectives, and also I think
Building communities.
yeah, a sense of I guess a sense of equity in that there's more fairness. But okay, for example, in the case of Sushi Swap, when they tried to make it a full-fledged DAO, it became a mess because there was a lack of best practice, there was a lack of transparency. Turns out it wasn't actually a proper DAO, but behind the scenes, without regulation, without oversight. A lot of people were just maybe misappropriating funds or taking bigger shares of things here and there, and also sometimes they weren't doing due diligence in the way that they're meant to. I mean, this is what I read in the in a few of their coverages. It turns if the actual situation is different, that might be that could still be the case. But the main point is that I think lessons from Sushi or with a lot of other projects is that I think greater participation is always good, but I think even in the crypto world, there is merit to having some kind of a corporate structure that is reinforced by experience and by best practice. And I think with us, for example, when we expand globally, Bitazza Global, we already have an expansion committee that's doing due diligence in terms of regulatory framework, legal, in terms of just trying to make sure that we do our homework before we go into a new market. So with that, we're not going to have a DAO and just let people vote what market we're going to go into. I think that would be irresponsible. But then once our expansion committee has decided on certain countries, we would then, for example, maybe open up to voting by the DAO about maybe how many within a range that we specify how many tokens we should allocate to expanding in one country versus another country. And I think in a way that would also kind of raise general awareness and allow us to get feedback from the general market to see which of the two markets we're going to go into is more enthusiastic about us. And of course, if they have more people voting for more, that might make sense if we allocate a little bit more attention, more BTZ to expanding there in the beginning.
So it really sounds like there's a lot to be done from the community side, a lot of engagement, a lot of decision makings that they will be a part of. So let's come back a little bit to the redistribution and signaling at the very ends of the white paper before we say goodbye to our audience today. There is the appendix that mentioned quite interesting a game theory. So for those who are unfamiliar with this term, and I know we touched a little bit on the candle auction and the this whole buyback and redistributes modeling. So explain to us a little bit, please, about how you saw that to be a part of a lot of the information or the approaches that Bitazza is taking.
Okay. So yeah, redistribute and signal in the redistribution part, where to redistribute and signal, part of it is that we take the tokens we get from our partners as payment for them using Freedom Mall. We also potentially buy back from the open market, and we redistribute them in a way that signals the confidence in BTZ. One is that we sell them off at discount to our most productive and most deserving partners of Freedom Mall and whatnot. And the other way is we hold a candle auction for the market at large for people to offer to stake BTZ holdings. And for that, we're going to use a candle auction. And the reason that it works is because I suppose of the fact that there would be costly signaling. And what the appendix does is the appendix actually explains with a diagram and just extolling the benefits of, I guess, costly signaling. And I'll talk about that in a second. But just real quick. So with a candle auction, essentially what it is you have an auction where the time for it ending is randomized, and you don't know when it's going to end. And the reason why that's actually efficient in many ways is that with blockchain-enabled auctions, there are actually two prominent problems. One is front running, is that when someone's about to bid, someone else might be able to see. If you have a better computing system, if you have better internet connection, if you're more, I guess, tech savvy, you can see what their bid is about to be. You can front run by submitting a slightly higher bid just before that. The problem with that is that after a while, people who are getting front run, they don't want to participate anymore. And that decreases participation and overall revenue, or in this case, the overall amounts that people are willing to stake. And we don't want that. The other thing is that you have something where I suppose you can, the auctioneer or even other people participating, they could, I suppose they could drive up the price that people have to pay, or the amount of people to stake to basically maybe extract any surplus utility they would get. The way that would work is that with blockchain-enabled auctions, a lot of people actually participate in the auction with smart contracts that say what's the highest amounts they're willing to bid. Now, someone can see my smart contract that says I'm going to bid at most, let's say it's a normal auction where you're not bidding the stake stuff, but you're bidding with money. I'm willing to pay at most $9 for something. But of course, you know, maybe everyone else, maybe me who's running the auction, you know, I'd be happy if I could sell it for $5. And there's someone else who might bid $6 or whatever, but the person who wants it the most wants it for $9, and he'd be willing to pay for $9. But in a normal auction, he would only have to bid 6.1, and he would get it already because his bid would be the highest. But with a blockchain-enabled auction where people are using smart contracts, there are ways where people can see, hold on, this guy is willing to pay up to $9. So suppose I'm running the auction, for example, I might submit a fake bid, pretend like it's from someone else, and bid it up to $8. I don't want to pay for the stuff myself, but I bid it up to $8 to force the guy to bid up to $9. So instead of getting it for 6.1, he gets it for $9, and the benefit that he gets is actually decreased by quite a lot. What is the problem with that? Well, this lack of transparency, this type of underhandedness that can happen in blockchain-enabled auctions means that over time, people don't want to participate. And obviously that means that these series of auctions eventually would become less and less popular, and it wouldn't work. But candle auctions actually circumvent this problem quite well, because when the ending time is randomized, for one, you can't front run. You can't submit a last minute bid that's slightly higher because you don't know when the last minute's going to be. And the other thing is also, I don't want to just falsely push up the bid higher with my own bid. Suppose I'm running the auction and I know that the person's willing to pay up to $9 and they're only bidding $6. So I bid $8. But then what if before the other person can bid $9, the auction ends? I'm left paying for for something I don't want to pay for, because I'm the one selling it and discreetly bidding for it. So essentially, the fact that you don't know when it's going to end, it really discourages people from submitting false bids to just push up the price. So those are the two major ways that candle auctions really mitigate these two big problems with auctions that are run by blockchain. And that's why we're using a candle auction. And just before I move on to the next part, there've actually been academic studies to show that candle auctions, when you work out the results mathematically, the results that you get approach what you call a second price auction. Second price auctions are when a bunch of people bid. Whoever wins with the highest bid, you pay the second highest price. And why is this important? It's because it's been shown in a lot of mathematical and economic circles that second price auctions are some of the best auctions you can have in terms of efficiency. You get the highest amount of revenue, or one of the highest, and also you maximize utility, which means people who want the good the most, they're the ones that get it. So candle auctions approach second price auctions in terms of the outcomes you get, which means that by having our auctioning process in the second part of the redistribute and signal be a candle auction, the outcome would approach the outcomes of a second price auction, which means that the revenue, or in this case, the amount of BTZ stake will be higher than most of the types of auctions. So that's one. We get a stronger signal than if we use other type auctions. The other way is that the result is socially efficient because the people who value the thing being auctioned off the most are the ones who get it. And that really resonates with us, because for us, it means that the people who believe the most in our ecosystem, the people who truly want to stake the most BTZ, they're the ones who get it. And that's what we're all about.
Mm-hmm. Mm. Interesting. So I think that was really well explained, and there are a lot to unpack here, because as you can see, we had really put a lot of thoughts into not only talking about tokenomics or
Okay, I think my co-host dropped off, but no problem. I think what Kun Didi wanted to talk about was this.
Hi, I'm back.
Hello, hi. I was about to.
Yeah,
Continue.
right. Yeah. So I was just talking about the fact that there's a lot to unpack here in the white paper 2.0. Not only the use cases, not only the tokenomics, not only a lot of the theories, but essentially there's a lot of storytelling. So we would really invite everyone who is interested to learn about our ecosystem and all of the upcoming products and even markets that we are intending to go into. But I think before we part ways today, there are several questions that have been submitted by our fans here on the Bitazza Global page. So I think actually there are two similar questions from Kay Wong, asking when you open a global trading market, what is your target country for the next official opening and when? So actually, let me answer the fact that the global platform has been open, and you essentially use it from anywhere in the world, with an exception of several countries. It's just that now the fiats on ramp and off ramp are limited to a variety of the currencies right now. For example, if you download the Bitazza Global application, you will see that there are 8 to 9 currencies right now, including Australian dollars, New Zealand dollars, Vietnam dong, and so on and so forth, Singapore dollars as well. So essentially, this is the direction of Bitazza Global. However, the Bitazza Group is actively working on obtaining the license, which would allow the fiat conversion with the domestic market, similar to what we had done for the market in Thailand. So I think this is something that you would have to stay tuned and be updated just right here on all of our channels on Bitazza Global. Again, as I mentioned at the beginning, having been originated from a compliance environment, that is definitely the goal, and that would actually set Bitazza apart from all the other platforms. However, if you are trading with the stablecoin pairs, the Bitazza Global app is accessible from anywhere already. Okay, and then there was also Pontakit Gone asking the same question, when TZAT would be open on global foreign country. I think we addressed that question, unless the question was about the BTZ token being. Yeah, go ahead.
Yeah, just to add to that, to the extent I think if to the extent you're not just asking about the global platform, but asking about where we're gonna venture into when we're gonna actually physically go into a different country per the white paper, because we talked about that. That's something that will happen imminently this year. But in terms of the exact quarter, exact month, that's something that I think we're going to keep to ourselves for now. In terms of these specific countries, I think you understand we don't want to pinpoint exactly which country and when we're going into, but the white paper does give a rough idea at the end about the type of markets we're looking at. Two types, mainly. One with maybe a lack of financial inclusion through traditional
Exactly.
brick and mortar institutions, but also with high crypto adoption. Another type would be the ones where maybe it's developed economy, but they have pretty crypto-friendly regulations, and they also have a lot of crypto innovation and a little bit of I suppose, regional hub for crypto where we could go in and also maybe test some pilot schemes as well. The other caveat we would say, besides from saying that those are, I think, a general rough plan and our specific plan we would announce as they happen. The other thing is that these plans, of course, are fluid, and our global management committee, global expansion committee, pardon me, also obviously I think recalibrates our strategy as I suppose the regulatory climate shifts as well, because
That's right.
what was last year might not be true now. For example, Portugal is known for being a very friendly, crypto haven, I suppose. And so far, there's been no capital gains tax or any kind of tax on people who trade crypto, as long as you don't do it as a main profession. But in May, I think on May 16th, 2022, so this year, the finance minister for Portugal did say that there will be an impending crypto tax. So that's something we have to look into. It doesn't mean that Portugal is off the list, because, okay, for example, Portugal's highest capital gains tax is 28%. But that's still comparable with the highest capital gains tax for Spain, which is 26%. And even then, for both those countries, it's still, considerably lower than income tax of 50% in the UK. And Spain is still flourishing as a crypto market. So that's not to say that if there's tax, we're not going to go. I'm simply saying that is something, where we go specifically is something we are constantly reevaluating as the situation changes.
Definitely. So the last question before we go, again, that's the same gentleman, K. Wong asked. A moment ago talked about staking. I'd like to know what your thoughts are on the recent results that have dropped a lot, make it not worth it for investors staking and may not want to next time. How would you respond to that, Tan?
No, I think the it's definitely a problem that I think a lot of the staking yields have dropped, and also even if staking yields haven't dropped in themselves, if the underlying currency value drop, then obviously, at least in the short run, that definitely hurts people's returns. For us, I think there's no magic solution, but I think the way we try to mitigate or lessen that from being an issue for us is that one, our staking pool will come to incorporate income from our ecosystem. And that means that we're not, for example, one of these DeFi projects that can only give you a high yield if there's other people chasing you, giving us their money, and we use that to pay it out. Because that, for lack of a better term, has, I'm not going to call it one, but it does have uncanny resemblance to what one might liken to a Ponzi scheme. And so that's me being diplomatic. So with us, we're going to have real sustainable revenue that will generate the yield. That's one difference. The other difference that we're going to have is that, as we said, we want people who take long-term views. And I think if you take long-term views, if you're getting yield in a pretty high percentage, but somehow the yield is paid out in the currency that keeps dropping. Well, if you're taking a long-term view of not even like years, but more than just a few months, more than a few weeks, then you can have some confidence that the currencies you're getting paid out in would actually recover in value as well. But the third thing I want to point out is that, Mr. Wong, I like that you mentioned that some people might not bother staking next time, because actually, I do think that there's a difference between people who might be particularly fearful of staking should the yield drop in the short run, and those who wouldn't. And that difference is that, in the former group, people believe in the platform, and the latter group do not. And that leads to what we call a difference in the signaling costs. And that's actually something that's mentioned in the appendix, which I didn't touch upon too much just yet, but everyone feel free to read in your own time. But just to simplify it, essentially, in game theory, which we use as a way to, I suppose, simplify more complex solutions and try to come up with where the equilibriums, the the points that the situation would naturally gravitate towards would be are there's something that that's called, I suppose, a game of incomplete information, which is when different people are playing and I don't know everything about everyone else, and everyone else doesn't know everything about me. A perfect simulation of a perfect example of an incomplete information game is financial markets, because if I'm looking to buy a token, I don't know what the other people in the markets, what people holding the tokens are thinking. I don't know if they're just there for short-term speculation or long-term speculation. Supposing, for example, that you have a game where there are three different, I suppose, players, right? One is player, I can't quite remember which player was which in the appendix, but essentially there's one player who is player 2, I believe. He is the incumbent. He's already there in the market. He holds some BTZ already. And I'm player 1. I'm looking whether to go in the market or not. And there's nature. Nature is player number 3. Nature doesn't care about anyone, but nature decides what type of a player 2 is. Basically, nature is just a way that we model the fact that I don't know what type of a player the guy in the market already is. He might be what we call in the NFT circles a paper hand, in that he's just there to hold the token for short-term gains, but at the first sign of any I suppose attack on the valuation, he would drop the token. Or he might be a diamond hand who truly believes in the long-term prospect of the platform and the utility token that it has. And if I'm player 1 looking to go in, the type of player that player 2 is makes a big difference for me, because if he's a diamond hand, then I can go in knowing that, if most of the players in the market really believe in the token too, if I go in, then the risk of a widespread collapse in the price of the token, as long as the ecosystem keeps growing, is actually quite small, quite minimal. But if he's a paper hand, then I know that if I go in, even if this ecosystem could really flourish, there's a pretty high chance that in the short or even medium term, there might be a market downturn and everyone would start selling. And that, even though I believe in the token, it would still, adversely affect the market. And also maybe that might lead to like some kind of I suppose, downward spiral, at least in the medium run for the token before it recovers. And therefore I want to discern what type of a player the player is. So anyway, so in the appendix, without going into too much detail, I demonstrate that the way that you can have a separating equilibrium, which is when you have different types of players doing different things, which is that a player who is a paper hand would not bid to actually stake his token, and a player who is a diamond hand who believes in the token would actually bid to stake the token. And I would be able to tell correctly what kind of player the player in the market is on whether he bids or not. If he bids and he stakes, he's a diamond hand. If he doesn't bid, he's a paper hand. The way you get this kind of the way one gets this separating equilibrium is through difference in signaling costs. And the difference in signaling costs here is actually something that Mr. Wong already pointed out, because if I'm someone who doesn't believe in the future of the Bitazza platform, for me, the psychological cost of bidding in the candle auction is much higher than if I do believe it. Because if I don't believe it, I think, hold on, I stake this, I don't get the coin back for 6 months. What if the token price collapses? I can't sell it for a short run like flip. But if I believe in the ecosystem, I believe they're going to build something great. I can see the actual vendor numbers growing every month. Then I think, hold on, I can stake for 6 months. At the end of 6 months, even if there's market market cycles here and there, the platform will keep building, and eventually the token's value will be supported by that by the transaction revenue of the ecosystem. So psychologically, and therefore the expected economic cost of staking is much higher for someone who doesn't believe in our platform than someone who does. And also, you could even argue that economically, there's another argument, which is that a lot of short-term speculators, they actually trade on margin, and therefore that makes the economic cost of staking longer for a longer period higher than for someone who is actually just investing in long-term with money they can afford to invest as well. And that difference in signaling cost, as the appendix shows, is what allows a separating equilibrium to happen, because in that equilibrium, even if I believe a person who stakes is definitely a diamond hand, if a paper hand or someone who doesn't truly believe in the token's future decides to switch to bid to actually stake his auction, even if he tricks me into going into the market, it's not optimum for him. It's not worth it for him, because for him, the psychological, the monetary cost of staking is too high, and therefore he won't do it. He won't try to trick me because it's not worth it for him, because the cost for him of tricking me is too high. And that is exactly what a Nash equilibrium is in game theory, where no one party can unilaterally, so by himself or herself or themselves, do something different to improve their payoff. And because no one will do that, that is the situation that we stay at. And that is how we achieve, I suppose, what we think would be an optimum outcome that allows the BTZ and the Bitazza ecosystem to redistribute and signal with costly signaling through the candle auction.
And this would be beneficial for the ecosystem in the long term, for sustainable growth. So that's all really, really interesting. With time running out, actually, we've been talking for quite some time now, 80 minutes. I would really encourage anyone who would like any more information on the direction of Bitazza Global, and as we mentioned, the products, as well as markets, and all of the financial modeling that Thunj mentioned here. And I think that it's so important to, spend this time during the market, being or leaving some people concerned about, the situation right now. So, I would like to take this opportunity to invite all of the viewers all around the world to look into it. And I just cannot wait to see what unfolds for the second half of the year for us here at Bitazza, because I think it says quite a bit as well for us to be, trooping on during what would now be the bear market. And that has always kind of been a trend where, regardless of the current situation, we're not following the market. If anything, it's a point to go against the market, because we really believe in creating the long-term benefits here, and contributions to our users, not just our users, but the industry as a whole. So that's really, really cool. Before we part ways, did you have any last words to share with our audience?
Well, thank you for giving us a platform to communicate to you. As I mentioned, I think we definitely believe that transparency is key, and also we want to work with the community to build confidence in our platform, in our token. That's partly why we think that the auction approach really appeals to us, because it does allow our most vocal, enthusiastic supporters to literally put the money where the mouth is, but also to become stakeholders who are rewarded as we grow.
Thank you so much for your time to walk us through all of the more than 30 pages of the white paper. And thank you everyone who has been following us all this while. And just because this is the first episode, it doesn't mean that it's going to be the last. We'll be talking and meeting you guys a lot more here on Bitazza Global channels. So if you had any ideas, just drop us any message in comments, or send us an email, or drop us a message, just write in the direct message. So with that, I'm Didi, the Chief Communications Officer, and Thunj here, the Chief Economist of the Bitazza Group. We are very excited that you are interested in what we're building here, and thank you so much for your time again.
Thank you. Thank you for having me. Bye.
Bye-bye.